Everyone keeps talking about the price targets, halving cycles, EFTs, but almost no one's talking about the war happening right now between the biggest players in crypto. A silent war that's shaping every chart you're watching. This isn't retail versus whales anymore, it's whale versus whale, and most people don't even know it's happening. Welcome back to the channel. If you're new here, I'm Paula, and this space is all about pulling back the curtain on what's really going on in crypto and global markets. We look beyond the hype, beyond the headlines, and dig into the signals that actually move money. And if you want to be part of a community that does the same, it's the Crypto Wolfpack. Stick around until the end because we've built a space where we share data, talk strategy, and help each other stay ahead of these games. Now let's get into it. On the surface, the market looks calm. Bitcoin hovers, Ethereum grinds sideways, stablecoins seem, well, stable. But when you look beneath, on-chain, in derivatives data, in exchange liquidity, there's a storm building. Over the last few weeks, we've seen billions in BTC and ETH quietly move between cold wallets, exchanges, and custodians. Some of those wallets haven't moved in years. Others are brand new, set up only days before executing $100 million transactions. Whale trackers light up like Christmas trees, yet mainstream outlets barely mention it. These aren't random transfers, they're strategic. They tell us there are factions forming, big money players positioning for what comes next. And make no mistake, these whales don't trade, they plan. So who are the whales? Let's quickly define them. There are roughly three kinds. First, the old school crypto whales, early adopters, miners, funds that held Bitcoin since it was worth less than a pizza. Second, the institutional whales, entities like BlackRock, Fidelity, and large family offices now managing crypto exposure for clients. And third, the exchange and stablecoin whales, Binance, Tether, and other issuers that hold and move massive reserves. Each of them wants something different. The OG whales want sovereignty and long-term appreciation. Institutions want control and predictability. Stablecoin issuers want dominance. They want their token to be the dollar of the digital world. And when those motives collide, you get the conditions for a whale war. Start with Bitcoin. Over the last quarter, on-chain analysts have identified a sharp divergence. Long-term holders are quietly increasing their stacks, while short-term speculative wallets have been dumping. But here's the twist. Some of that accumulation is coming from institutional custody wallets, not individuals. It looks like accumulation, but whose accumulation is it? A genuine long-term believer adding to cold storage, or an institution front-running its own EFT flow? Either way, the effect is the same. Supply is being locked up. At the same time, exchange reserves are at multi-year lows. That usually sounds bullish, except when you realise where these coins are going. Many are moving into OTC desks and wrapped products, meaning they're tradable just off exchange. So while retail sees supply shock incoming, the whales have simply moved the game board. Ethereum tells another story. While Bitcoin whales consolidate, Ethereum's top wallets are splitting, some staking huge amounts for long-term yield, others liquidating and shifting into stablecoins. The tension is obvious. Is Ethereum a decentralized network or an institutional product? Large funds want predictable staking rewards, regulatory clarity, and integration with traditional finance. DeFi purists want freedom, anonymity, and open protocols. Both sides are using their ETH to vote, not in governance proposals, but through liquidity positioning. When billions in ETH shift from staking to exchanges in a single week, that's not a coincidence, it's signalling. It means one side believes volatility is coming and they want to be mobile. Then we have the most misunderstood part of this entire war, the stablecoins. Everyone uses them, few question them. Tether, USDC, and a few new players like FDUSD and PYUSD act as the bloodstream of crypto. But these flows also reveal the power balance. When billions in Tether suddenly migrate between chains, or when Binance mints a wave of new tokens, that's liquidity ammunition. It's how exchanges influence markets without touching the underlying assets directly. Pump or dump, stablecoins are the fuel. Some analysts call it a coordination mechanism, others gentle market making. Either way, whoever controls stablecoin liquidity controls the tempo of the market. And that's why you'll often see Bitcoin fall while stablecoin dominance rises. The whales are reloading, waiting to strike when retail is exhausted. So how do these whales fight? Not with memes or tweets, but with liquidity warfare. They move in layers. Step 1, build narrative momentum. A headline here, an influencer comment there, an EFT rumour, a suspicious leak. Step 2, shift capital quietly while sentiment reacts. Step 3, trigger liquidations through derivatives pressure. And step 4, accumulation again at the bottom. Every crash you've ever seen follows that 4-step rhythm. It's elegant, ruthless, and perfectly legal. Retail traders chase candles. Whales chase liquidity. They don't care about price direction, only about harvesting emotion. Right now, blockchain data shows enormous clusters of activity around key psychological levels. In Bitcoin's case, around the 95 to 105,000 range. That zone has become the trench line. Below it, long-term whales are defending positions, adding slowly. Above it, leveraged funds and exchange whales are selling into strength. It's a tug of war where both sides hold billions in dry powder. And in the middle, us. Retail traders, small funds, everyday investors trying to interpret the noise. And that's why the market feels directionless, because it is. We're watching two titans pull liquidity back and forth until one side breaks. So why are the whales fighting? The reason for this conflict goes deeper than profit. It's about control. Control of market infrastructure, of narrative, of sentiment layers, and eventually of the new global money system. Bitcoin represents freedom from traditional finance. Stablecoins represent a bridge to back it. Institutions want regulation and predictability returns. Crypto natives want autonomy. Those are fundamentally opposing goals. The whales know whichever vision wins this cycle sets the rule for the next decade. If Bitcoin stays dominant, decentralization still has a chance. If stablecoins and EFTs take over, crypto becomes just another Wall Street product, digitized but domesticated. That's the real whale war. We've seen this before. Every major asset class goes through a phase where insiders consolidate. Commodities in the 1800s, equities in the 1900s, the internet in the 2000s, now it's crypto's turn. Back then, markets were manipulated through information asymmetry. Newspapers, telegraphs, insider deals. Today it's data, bots, and order flow. Same playbook, new technology. But there's one key difference. Blockchain exposes the battlefield. Anyone can see the moves if they know where to look. That's what makes this moment so powerful. For the first time, the public has access to the same raw data as the whales. The question is whether we'll use it. So how can you tell when a whale's about to act? First, watch exchange inflows and outflows. When you see massive Bitcoin or ETH deposits, it usually signals selling pressures ahead. When coins are being withdrawn to cold wallets, that's accumulation. Second, track funding rates and open interest. If funding is extremely positive while price stalls, whales are likely setting traps for over-leveraged longs. If funding flips negative during consolidation, they're prepping a short squeeze. Third, monitor stablecoin supply. Sharp increases often precede rallies, liquidity injection. Sharp decreases mean liquidity is drying up. None of this is prediction, it's pattern recognition. Whales move in rhythm, you just have to listen for the beat. Retail traders lose not because they're stupid, but because they're emotional. Whales understand emotion better than anyone. They study fear, greed, impatience. They know how long people will hold a loss before capitulating. Every time you feel panic or euphoria, remember, that's a liquidity event for someone else. They sell when you believe it's only going higher. They buy when you're sure it's over. The secret isn't to beat them, it's to stop feeding them. Slow down, observe. If you understand the rhythm of their war, you can step out of the crossfire. So where does this go? If institutions keep accumulating through ETFs and custody products, we could see a slow, grinding bull market. Controlled, moderate, designed to attract pension money. If the decentralized side regains momentum, maybe through a new tech catalyst or political event, volatility will spike as capital shifts away from centralized control. Either way, another major move is coming, and it won't be triggered by headlines. It will start quietly in the same places it always does: whale wallets, stablecoin mints, and exchange order books. When you see those three things line up, the war enters its next phase. Zoom out. This isn't just a market story. It's a reflection of human behavior. Power always centralizes until something disrupts it. Crypto was supposed to be that disruption, but even here, power is trying to re-establish itself. The question for all of us is simple. Will we let the same pattern repeat, or will we build something truly different this time? Because if decentralization dies under the weight of its own whales, then all we've done is reinvent the old system with better graphics. Whales will keep fighting, markets will keep swinging, but you still have a choice: to educate yourself, to understand the flows, and to stay emotionally neutral when everyone else is panicking. The truth is, you don't have to predict the next move to survive the war. You just have to stop fighting battles that aren't yours. When the whales clash, let them. Watch, learn, wait. Because every war eventually ends, and when it does, opportunity is born from the chaos left behind. If you found this breakdown useful, make sure you hit subscribe and share it with someone who keeps wondering why their trades always get liquidated right before the bounce. And if you want to go deeper, to actually see these moves as they happen and talk with people analysing the data every day, come and join us in the Crypto Wolfpack. We've built a private community where we track the charts together, decode the narratives, and stay one step ahead of the manipulation. The link is in the description of this video. Until next time, remember, the whales might control the tides, but the tides always turn. Thank you for watching this video, and I'll see you on the next one.